Hi, this is Jim Cunningham. I'm here with Alyssa Kroger and Shannon Behan. We're here to talk about life insurance, getting it right, and unfortunately, sometimes getting it wrong. So obviously, we want to avoid getting it wrong. And we are here today. This is a discussion. This is not a advice. This is not financial advice. This is not legal advice. Obviously, we want to make sure that you seek out a competent professional, ideally an A-team. You can go ahead and subscribe to our YouTube page. If you're watching this on YouTube, it's very easy. You click the subscribe button. And also there's a share button. If you see that this information is valuable, maybe you want to share it with a friend or a family member, please go ahead and forward that to them. Our law firm has offices in Northern and Southern California. We kind of cover a broad geographic area. You can see there the palm trees and the Golden Gate Bridge. Our firm is, we've got our attorneys here solely devoted to trust and estate matters. And I'm the CEO and partner at Cunningham Legal, over 25 years experience. And we help clients in other states as well, Missouri, Texas, Virginia, and the District of Columbia. Also a certified specialist in estate planning, real estate broker, securities insurance licensed, and a pilot. And we have with us two really great certified financial planners who happen to be women, obviously, which is great because if you are a woman and you're looking for financial advice, or a man, it is very hard to find women financial advisors who are certified financial planners. So Shannon and Alyssa, maybe if you can explain a little bit what a CFP is and why it's important versus, just having it with some big institution. So tell me your thoughts on that.
Sure. So I would say certified financial planner, or CFP, is probably the highest standard. It is the highest standard in our industry. Actually, there's two that are probably the highest designation. There's the CFA, which are the people that are kind of behind the scenes looking at doing portfolio construction. They're kind of the main analysts that fulfill portfolio construction for mutual funds and things like that. And they don't deal directly with clients typically. And then there's CFP, and that's a certified financial planner. We deal directly with clients, and we're really well versed in areas that go beyond just investments. A lot of times people have a misconception of investment advisors or financial advisors because they lead with investments. We tend to lead with everything other than investments: retirement planning, tax strategies, how do we mitigate taxes, business planning, estate planning, insurance, and then investments is a small piece of that. And so we're really well versed in those areas.
And I guess one of the elements here is life insurance, because, a lot of people have life insurance. Some people don't. Some people say, I've heard about life insurance. How much should I get? Is this for me? Is it not for me? And, if you Google life insurance, there's all these different kinds of insurance. So with that, let's talk about, and I'll just hand it off to you, and Shannon and Alyssa. Let's talk about the real high level about life insurance.
Yeah, I think to Alyssa's point, insurance is one of those really important pieces of the overall financial picture, right? I don't think anybody would take for granted the need to insure your home or insure your car. But I think oftentimes this conversation around life insurance can be rather complex and sometimes a little bit overwhelming. So our hope for today is to kind of distill it down to some of the basics. What do you really need to know? Answer some of those questions and sort of have a little bit of a mindset shift as well, from thinking about insurance purely as a mechanism for protection, which it certainly is and does, and that's its main function. But there's also a piece where we encourage you to start looking at it as a part of the overall scope of investments in your portfolio and how insurance can step in there as well. So I think one of the questions that we get constantly about insurance is, well, how much insurance do I need? And there's a lot of kind of these simple formulas and calculations out there to help answer this question. You Google it and there's different calculators where you can input information. And we've got some of them up here on the screen, whether that's in reference to a multiple of your income, or thinking about, covering income plus college expenses. I always like acronyms. The one I like here is DIME, right? So covering debt making sure that you have enough coverage to cover student loans. For example, if you're a young couple, multiples of an income, pay off a mortgage so that you don't leave your spouse without a place to live, education for the kids. But all of these formulas kind of focus on insurance as purely a protection aspect. And quite frankly, a lot of these ways of looking at how much insurance is enough assume that you're in the beginning phases of your life, that you're still in those, early working years. And there's needs for insurance for other purposes later on, which we'll kind of talk a little bit about. So the way that we sort of help answer this question for clients is by looking at, what phase of life are you in? Certainly, if you have dependents, if you're a young couple, if you're thinking about having kids, there's a need for insurance, quite frankly, because one of your biggest risks that you would pose to your family would be the loss of your income. So we're talking about life insurance today, but that could also open the door to disability insurance as well if you were to lose your income. So life phase is important. If you're early on, you need that life insurance, but also thinking about later phases of your life. Do you have long-term care coverage? Do you own a business? These can all change your need for insurance, even down to thinking about, do you have dangerous hobbies? Sometimes it's hard to insure yourself if you do, but really kind of thinking about all of the different aspects of your life can help us decide, do you need coverage? The second would really be, what's the purpose for that coverage? Is it to replace your income? Is it to provide a legacy to your family? Is it, do you have charitable aspirations as well? That can help determine how much insurance might be the right amount of insurance for you. And quite frankly, how will you fund it? It's insurance, like I said, could be really necessary if you have dependents, but also that might mean that you're in a phase of life where there isn't a lot of, extra funds to divert towards insurance. And that can really help drive what's the right product, how much is enough.
And Shannon, I would say too, in addition to another area where people tend to forget, is they'll insure the income earning spouse if there's only if you're a one income household, and not insure the person that stays home, whether that be the husband or the wife or whomever. And really, you have to put a dollar value on who's staying home, and what that impact, if they were gone, what financial impact would that have to replace that person? They offer some sort of an income, even though it's not income generating. It alleviates stress on the income being brought home because somebody is doing those duties inside the home, whether it be caring for children or whatever else. But that's something that often, more often than you would want to think, gets missed.
Yeah, it seems like earlier on in life, you're talking about replacing 10x of your income. You're replacing, if you're 25 and you're starting out in life, yeah, it's time to get a life insurance policy. I did that when I think it was 25 or 27, and I'm in my early 50s. And now those 20-year terms are up, and we're in a different financial situation now in our 50s. So if you're watching this and you're in your 50s, or you have kids in your 50s or 20s or whatever it is, it's really important to kind of look at this from a much higher, broader view, which is, yes, when you're younger, term insurance, and we'll talk a little bit about this, but for a period of time does make sense. And then what we also see as people get older, and people do pass away in their 50s and 60s, and kind of unexpectedly. And I was at a client's funeral just last weekend, and it was very tragic. He'd just retired and left his wife, and they'd been married many, many years, and so now she's got this void in her life. Now, fortunately, they have, the wherewithal that she's going to be fine, but life insurance can serve a different purpose at age 60. Now, if you're a business owner, think about all the leases you're on, all the equipment leases, you got this business running, you probably have a lot of personal guarantees out there. You need to make sure you have enough insurance so that if that company is solely dependent on you and you're not around to run that company, your spouse, your loved ones, they're going to have to settle up with all the creditors, and it's a real issue, and it can be a real disaster if you're not prepared for things that aren't pleasant, but often there's a probability. It might be small, it might be big, but there's a probability of it happening. So if you can kind of walk us through, I hear clients come to me and they say, Jim, I hear life insurance, I hear term, I hear permanent, I hear all this stuff. Just help unpack this for us. Walk us through this.
Yeah, so I heard once that the best kind of life insurance is the insurance that's in force on the day that you die. And I really think there's something to be said about that. It's we need to make sure that we're just thinking of filling that need first. But we want to make sure that there's different products out there and you want to make sure that you understand them. We will dive into each one of these a little bit deeper, talk a little bit about the pros and cons. But from a high level, essentially what we're looking at is generally the difference between term insurance, which you could also think of as temporary insurance, and permanent insurance. And there's a couple different types which we'll walk through. Private placement, we're not going to talk about too much because this is really kind of a niche solution for very high net worth people, for people who are business owners who have illiquid assets. But we just wanted to mention it here so that you know that it exists and if it might be the right fit for you so that you can explore it. But really the main distinction is between temporary or term and permanent. And the way I sort of think about these from a high level is the difference between sort of renting your home and owning your home. With term insurance, you are paying a premium for a specific amount of time. And should you pass away during that time, you get a death benefit. So you're essentially renting the death benefit. Permanent insurance, on the other hand, is designed to last your entire lifetime. And so you're paying that premium like you would if you owned your home and you're making a mortgage payment. And those premiums that you're paying over the course of your lifetime are accumulating a cash value for you or building equity like you would in your home so that you then can access it in the future. So that's kind of one way that I like to think about it. You'll see here that we'll dive into, the difference between whole life, indexed universal life. One thing I really want to make sure that we touch on is we know that this is complicated, and that's why it's so important to get the right guidance. And I think sometimes insurance sales gets a little bit of a bad reputation, kind of like a used car salesman sometimes. But it's also important to understand that there are different types of people who engage in helping you find the right insurance product. And a lot of these agents are what we would refer to as captive agents. So these are the type of agents that the companies that you see commercials for on TV, where if you were to call them, they can only offer you the products that their company provides. And that's a limited number. They have to only show you these proprietary products. Versus working with someone who's independent, that's not captive to one particular company, has access to the entire range of companies that provide insurance. And within those companies, they have access to a number of different products. So finding someone who really has that independence so they can access all of these very highly rated companies, but also has a really strong understanding of all of the different types of insurance and can help customize a policy to your exact situation is absolutely crucial when we're exploring these types of policies.
It's also important to note when you're watching this and you're listening to Shannon and Alyssa talk, Alyssa and Shannon are insurance licensed and securities licensed. And it's very important to understand if you have an advisor that does not have an insurance license, they are prohibited by law from selling you life insurance. You have to be licensed. And if they're prohibited from selling it, they might say, oh, you don't need life insurance or you don't think about life insurance, focus on your stock portfolio. Because they're not licensed to sell it. Okay, so that's another sort of behind, if it's the Wizard of Oz and we're kind of pulling the curtain back and seeing, the truth of how financial services are sold. If you're not licensed, you have no motivation to sell it, and you may actually be precluded from mentioning it if you don't have that licensing. And the two ladies you see here are fully licensed. So that's good.
Yeah, and Jim, the flip side of that is also you can be insurance licensed, and there's also certain insurance products that you can't sell if you're not securities licensed. So it's really important to work with somebody that has both. So term insurance first, I think this is what most people think of when they initially think of insurance. This is that temporary insurance. This is something that you sign up for a known period of time out of the beginning, whether that's 10, 20, 30 years. 20 is typically the most common. And you are given a certain annual premium that you have to pay every year for those 20 years to keep your death benefit in force. That premium doesn't change over the course of that term. If something were to happen to you during that period of time, your family or whoever you designated as the beneficiaries would receive the death benefit on that policy. Because of its temporary nature, because it's a little bit more like renting than it is buying a home, it's also a little bit less expensive out of the gates. So you're really getting the most coverage for the dollar versus another type of insurance policy. So if we look at the pros and cons of a term policy, it's cost effective, right? You're getting the most coverage. Your dollar is going the furthest it can. It's really simple. You know, you go through the underwriting policy at the beginning, you get approved, and you know how much you're going to have to pay. You know what's going to happen if something happens to you. And sometimes also I added in here as a pro, there is a potential to convert some term policies into permanent policies. So that's something to explore if if term's the right way to go for you, if you're a little bit short on being able to fund a policy, having that ability to convert it to a permanent policy in the future can really help those dollars go a little bit further. Because if we flip to the con side, the main con here is really that it's a use it or lose it policy, much like your car insurance. You're paying that premium, but if nothing happens, if all goes well, there's no payout on the end. So there's also no cash value accumulation. Again, it's more like renting. This is also one thing I like to point out with term is that you really should have a good idea of what your financial situation will be in the future, which I know is oftentimes a lot easier to say than it is to predict. The reason for that is that some term policies make you re-qualify after your term has expired. So you have to go through underwriting again. And even if you don't have to go through underwriting, if your term expires and you need to start a new term, your cost of insurance is going to go up exponentially. It's never going to be cheaper to insure you than it is today. And I think that the concept of understanding that those rates increase exponentially is really important. So when you look at the cost of insurance against your age, it's not a straight line up. It's a line that really kind of hooks up. So the cost of insuring you at 35 versus 30 is a smaller difference than the cost of insuring you at 40 versus 35. So term can get very expensive very quickly.
And Alyssa, there's a place for term, right? I mean, if a young person who's like, look, I got 3 kids, I got a spouse. If something happens to me, we've got all these debts. There's a place for this. Okay.
Absolutely. I still have term.
I do too.
I have term. I still have term, and I got term when we first got married because that's all we could afford. And it's just one of those things that if you can't do it all, do what you can. And term is the perfect solution for that.
Yeah. And I would say the takeaway here is if you're watching this and you go, well, Jim, I'm 70. Like this doesn't apply to me. Yeah, you might have kids and they might be at an age where they should be looking at term insurance. And this is something really important because, we all want to provide for our loved ones. If you're watching this, obviously, I mean, not all people do, but if you're watching this, you're obviously interested in it. But we want to provide for our loved ones if we can't, if we're not there to be able to do that. And so life insurance aligns with the event that causes causes loss of income, right? You pass away, you can't work anymore. Disability is a little bit different. I also do want to mention, what about policies at work? Sometimes people are offered a $50,000 policy essentially for free. Should they take that or not?
Absolutely, they should take it. It should be an automatic enrollment when you have the first 50,000 because the insurer or the employer has to cover that first 50 grand, and it usually doesn't cost you a dime. Yeah. So at least bare bones minimum, make sure that you're enrolled in that benefit at your employer. And then if you wanted to add anything additional, that's an easy way to get it. And there's zero underwriting with that until you hit over a certain amount. But generally speaking, you can go up a couple $100,000 without having any sort of underwriting that's needed to be completed. The other thing I would say too is outside of just the employer benefit, just because your life stage changes or your affordability on insurance changes doesn't mean that you should get rid of term. Keep your term and just supplement with additional policies once you're able to afford those additional policies that may cost a little bit more. Because if you can keep your term, ideally that'd be the case, and then you're just supplementing with additional insurance.
Okay, so we have some questions here, which is one question is for the spouse that stays at home. Do you using the same 10x income strategy for the surviving spouse? So this one is where the spouse is at home and that spouse, the at-home spouse dies. Is it still 10x because they don't have earnings? What's a good way to look at that, Alyssa?
Yep. So a good thought process would just be 10 times, because again, they're providing income, even though it's not coming in the form of income, they're essentially alleviating stress on income. And so what is that alleviation? And so you can quantify that by having to have somebody come in and replace that person. So nanny costs, cost of having a housekeeper, so on and so forth. You add those all up as far as what it would actually be if you were to pay somebody else to do what that person was otherwise providing to the home. And you quantify that and multiply that by 10, an annual cost, and then times 10, and that should be a good sufficient number.
And then Anonymous asks, how much is high net worth? I think that was in question to private placement. I think it's really it starts making sense at about 10 million. So if you have a liquidity event of 10 million and above, so, if you have a business and you're selling it for 100 million, absolutely. If your advisors aren't looking at private placement insurance, I think you need new advisors. I think this is not necessarily that you should do it, but it's something that you should look at. Like if you're going to buy a luxury car, you're looking at Mercedes, BMW. I don't know if Tesla's in that bucket, but you need to look at all of them, right? You might pick one or two, but you should be looking at all of them. Can you convert term to permanent? The answer is yes. If you have a rider, and just think of like if the horse is the policy and a rider is the person that rides along with that's where the term comes from, you can have a rider that permits a conversion. And then Anita asks, we had some term policies and after they were fully paid, they were converted to stock. Is that normal? Yes. A lot of insurance companies were mutual companies, and then they went through a process to demutualize and become a stock company. And that's why you got stock. So that's where the stock's coming from. But I think is that all done? Like the demutualizing of insurance companies? Is that
you don't see that very often now.
Right. That's something from like 25 years ago. Okay. Let's talk about whole versus universal life. What is the difference?
So both of them are permanent, right? So that means that they're both designed to last your entire life. So from the time that you sign up, hopefully when your day comes, this policy is still in place. The difference here is mainly in, and remember, permanent policies accumulate a cash value. And the difference in these two policies or types of policies is really around how that cash value grows. So a whole life policy is not designed to accumulate a very large cash value. Essentially, with a whole life policy, when you sign up, you know exactly what you're getting. Your death benefit, you know what that will be. You know how much your premiums will be. You're kind of locked into that. And you'll get, for all the premiums that you pay in, that insurance company is going to invest those premiums. And you get to know ahead of time with a whole life policy how the interest will be credited on your cash value. And essentially what that means is that the insurance company is going to take your premiums, invest it in bonds, something very conservative, and you're going to get credited the interest on that bonds, which will be a very low amount for a long time. So safe, but you're also not going to have that potential for a lot of growth out of a whole life policy. Participating versus non-participating is also something that you'll hear in talking about whole life policies. Sometimes you hear par and non-par. And essentially what that means is that a policyholder will share in a portion of the profits from the insurance company. And the insurance company will pay those out to the policyholder in the form of dividends. And as a policyholder, you get to kind of decide how you want to receive the benefits of those dividends, and whether that is by adding on additional death benefit, whether that's applying those dividends towards your future premiums that are due, or in some cases, you can even get those dividends paid out to you in cash. So that's an election that you can make on that policy. But whole life, while it's kind of like the Cadillac of the permanent, because you know exactly what you're getting, it does have some downsides as well, which we'll talk about. about. But just from a high level, what universal life is on the kind of other side of that is universal life has more flexibility built into it. So when you go into a universal life policy, it is designed to last your entire life, but you have some flexibility in the premiums and in the amount of death benefit. So as your life situation, your financial situation evolves, maybe you don't need as much death benefit as you used to before. Maybe you can pay less in premiums. You have the flexibility of kind of adjusting those. So unlike a whole life policy where you're pretty much locked in, a universal life policy has a little bit more flexibility. The investment of what's called your reserves, or the premiums that you're paying in, is also different. And there's several different types of universal life policy. And those really revolve around how the reserves are invested. So you've got a guaranteed option, which is very similar to how a whole life policy would be invested. You know that interest crediting rate ahead of time. There's also what's called an indexed universal life. And in this case, your gains on your cash value are determined based on what an index does. Like say, for example, the S&P 500. That does not mean that the insurance company is taking your premiums and investing it in the S&P 500. What it simply means is they are agreeing to credit your cash value in an amount with a calculation that's based on that index. And that calculation oftentimes will have what's called participation rates. So let's say you have an 80% participation rate. That means if the S&P 500 goes up 10%, you'll get 80% of that as a credit, or 8%. There's also caps oftentimes on index universal life. So you might be capped at 12%. If the S&P 500 goes up 20%, you're not going to get any more than 12. But if it goes down, you also don't have to share in the downside of the S&P 500.
Yeah, it's important to understand participation rate is not a super positive thing. It's kind of like telling you, well, it's indexed to the S&P 500, but as you said, Shannon, you're going to get a haircut on that. You're going to get 80%, and then you have a ceiling. And if you look at the overall return of the S&P 500, many years it's up 35% or 33%. It can also be down. And maybe talk about the downside. Do you participate going down, or do you hit a floor?
You do hit a floor. There is protection for you there. The kind of next step over would be a variable policy. And in this type of policy, this is a policy where your premiums are actually invested in what I might call sub-accounts inside of an insurance policy. So you're actually able, with the help of an advisor, to help direct how your premiums are invested. And in that case, you really are taking on, the risk of the market, but also the participation and the risk of a fluctuation in value. We can see those values recede as well. So there's different types of investments available inside a universal policy.
Yeah. And I think the reason, so you're talking about investments in a life insurance policy, and you may be watching this thinking, what investments, life insurance? What are you talking about? The reason you have a life insurance wrapper around these investments is all the activity that occurs in that life insurance policy. Let's say you put money into the life insurance policy, it's going up and it's invested in stocks or an index or whatever it is, that all accumulates without paying tax. Okay, that's really important. So if it accumulates a whole bunch of value or dividends or whatever in that and stays in that policy in that 1 year, you're not paying income tax on that. So if you're a high W-2 earner, whether you're filing single or jointly, we have a lot of clients, many clients, two spouses are working, one's making 600 grand a year, another one's making 500 grand a year on W-2. I can tell you, if you're making $1 million, $1.1 million, you're getting clobbered on taxes. And if you're making that money, it's like, where do you go for any kind of tax planning? This is one of the avenues. This is one of the areas you can investigate as a tax saving strategy. Okay, it's very, very important.
Absolutely. So when we look at kind of pros and cons, different uses of permanent insurance, And Alyssa will talk a little bit about some specific cases where we've actually, utilized policies for specific needs. But when we think about permanent, we're thinking that these are going to be funds that are going to come to your family, your beneficiaries. Jim, to your point, death benefit is tax-free to your beneficiaries. And so we want to think about it in terms of how could we use it for things like final expenses, estate tax liability, which is especially important. We've seen for, if your portfolio, especially in California, we see this a lot, is really real estate heavy. Having an additional source of liquidity in the form of a life insurance policy can help make sure that your beneficiaries aren't having to, fire sale properties that have been in your family for years just so that they can have the liquidity to pay estate taxes, for example. So those are the kind of uses that we would see towards the end of life or at the end of life. We also have some ability with a permanent policy to access it before the death benefit comes into play. So there's different products that we have access to, different riders that allow us to access your death benefit ahead of time for things like long-term care expenses, or even taking out tax-free loans on the policy to help supplement retirement income. So these are all, the list of uses for these permanent policies is very long. Then when we look at pros and cons, I think we already touched on this. I think whole life is great if you are a set it and forget it and you need some certainty and that just makes you the most comfortable. If you are not planning on utilizing a lot of these living benefits, a whole life policy might be okay for you. It's going to be higher cost. So if you're young, it might be the right thing to do. You might be able to get a relatively good deal on a whole life. But just like we talked about with perm, that your dollar is going to go the furthest for the benefit, whole life is kind of the opposite of that. Your dollar is going to go the least far in terms of how much benefit. And there's no control from your perspective on how it's invested, whether that's selecting an index or underlying variable sub-accounts. You don't get to decide any of that. There's no potential for growth there. So when we look at universal life in comparison, having that flexibility, the potential for growth in the cash value so that we can use it during lifetime for some of these other needs is definitely on the pro side. Cons, we're looking at, you do need to be on top of the investments inside of these policies to make sure that they're performing the way that you want them to perform, that you're constantly keeping on top of the premiums, that you've got the right cash value to support the death benefit going forward. And we also put in here potential underperformance, because if you have no guaranteed rate of return, if the market just really does not do well, you might not get any growth in your cash value.
Yeah. And Alyssa and Shannon, I'll tell you, we're as we record this, we are in April of 2022, and it's been a rough year for stocks, right? For the equities market. And we were just talking before we got started, Netflix was down 35% yesterday. And I guess that's what Shannon, you said, it's what happens when you said, oh, we're going to have 10 million subscriber growth and you actually go negative. And this, I will tell you, if you're watching this and you have money invested in the stock market, if you're not a little stressed out about it, you either have a lot of money or maybe you're not thinking about it enough, because we're going through a really weird time. We're coming out of a pandemic. There's a war going on that has this crazy uncertain, is it going to be contained? Is it going to spread? And then we also have really high inflation. And I'm reminded, Alyssa and Shannon, this is obviously before your time, but I'll meet with clients and they got a policy in 1982, which was the peak of the last interest rate cycle. Some of them have guarantees of 8%. And one of the things we're going to talk about is life insurance has gotten cheaper recently, okay? Because it used to be the insurance companies would figure you'd live to be 100. And now they say you'll live to be 105. That has the net effect of making the overall cost of insurance go down. And so what many of our clients do is they will do a tax deferred exchange. To that point, we have two questions I want to address here. Leticia asks, I purchased a term policy for my 24 and 21-year-old daughter. Is this wise or not? Yeah, it is. Both will have student loans next year to repay. Is a 30-year policy, I think, better? I think that was a good question. Something to know, Leticia, about student loans. Many times those student loans die with the borrower. They're not dischargeable in bankruptcy, but they die with the borrower. And that's very surprising. Many of them, not all. And also, I think it's smart to get insurance. And I think it's probably worthwhile to have that reviewed. I don't know, Shannon and Alyssa, if that's something you could help Leticia out with, but I think it's very important to have it reviewed. Paras asks, Jim, when I was 18, my parents' insurance broker suggested I get an indexed universal life policy. I was the insured and my parents' living trust was the owner. Now that I'm in my late 30s, married and with kids, can I change the ownership of the policy to my estate or to the insured without making it a reportable policy sale that could change the death benefit subject to income tax? Boy, that's a tough one. Shannon and Alyssa, I will defer to you on that one, but I will tell you, Paras, you probably want to reach out to Shannon and Alyssa and have a conversation. And I'll let you answer that question, Alyssa.
Yeah, we would need to talk through the situation, of course. One of the things that we're always thinking about is, we want to understand the whole financial picture. How does, a gift from your parents' trust, for example, to you, have they made other taxable gifts throughout their lifetime? How is that going to be structured? So we could look at that for you and really help you, navigate what the consequences would be on that.
Anonymous asks, apparently term can be sold to certain companies for cash. How and why, if there's no equity in the term frequently advertised on TV? Anonymous, I'm going to give you a kind of a gruesome, morbid example. If you have a 20-year term policy and 5 years into that 20-year term, you're diagnosed with cancer and you're going to die in a year, that's called a viatical settlement. So you basically have to have an incurable, fatal medical condition, and then you can do an early cash out. That's good for you because you get the money. It's not good for the reasons you bought the life insurance for. It may be appropriate, may not be, but that's kind of creepy. Max asks, there was a fourth type of universal guaranteed indexed variable, and the slide skipped forward.
It said survivorship. Yeah. So what that means is it's a policy that insures 2 lives, which is something that we would see a lot for someone who is trying to cover, estate liquidity or create a legacy with these benefits. So that would be husband and wife are both insured. When husband just statistically is most likely to pass first, when he passes away, nothing happens with the policy. When wife passes away, then it goes to the beneficiary.
Salome asks, and by the way, that should be, oftentimes that's done for death taxes. Something important to understand, the death benefit on life insurance is not subject to income tax. It is subject to death tax. So many people will set up an irrevocable life insurance trust on these second to die or survivor benefit policies. Salome asks, if you're in your early 80s and are stable in your monthly income, but do not qualify for long-term care insurance due to pre-existing health conditions, any suggestions?
In early 80s, it's already getting to the capacity of being able to insure you. And if you have a pre-existing condition, there's unfortunately not anyone that would take on an insurance policy for that age of a person with a pre-existing. So unfortunately, it's just self-funding at that point, which also brings up the point of, making sure that you never know how insurable you're going to be tomorrow, and you're never getting younger than you are today. So insurance never gets cheaper. It only gets more expensive. So if you have the funds to be able to buy an insurance policy, do it sooner rather than later.
Yeah, I would just say with one caveat, Salome, is one thing is you might have been denied by one carrier and we're missing a little bit of information, which is the backstory. So I'd really encourage you to reach out to Shannon or Alyssa, have a conversation. If you went to XYZ company and that's all they sell is XYZ insurance products, there may be, if you go to more of take an approach that a CFP would take, a broader approach, there may be another company that would insure you when one sort of captive company, not captive is the wrong term, but when one particular branded company says no.
Yeah.
Anita asks, what is base used in universal / whole life? Is it the original face of the policy? I'm not sure.
Yeah, I'm not sure I understand the question. When we design a policy for you, we design it based on how much death benefit you initially need, or we can design it on how much in premiums you want to pay. One drives the other. And so that's kind of how we design it.
Doris asks, hi, Jim. I'm Doris in my middle 30s. I lost my husband. I'm so sorry, Doris, and have a 7-year-old daughter. I already have a small universal life policy in place. Do you think it's a good idea to add a term insurance to what I already have? Doris, I can't imagine losing your husband and having a daughter like that, my heart goes out to you. I think that's something you really should be meeting with a certified financial planner, whether it's Shannon or Alyssa or whomever, just someone who's good. You are in a very tricky place. And there are also other, I'm assuming you already got your Social Security benefits and other things, but there's a lot going on there. And it might be a good idea to add that term insurance to care for your daughter. But again, it depends on the overall situation with the family and who would take care of your daughter if something happened to you. But I would definitely consider it. I would definitely be something to take a look at. Venkat asks, I have a whole life policy which has accumulated significant cash value. However, I found out that the death benefit is the original policy value only and not the policy plus the cash value. What's up with that? Why is that? What's going on here? What's Venkat? Can you answer his question? I mean, that's her question. I don't understand.
So there's two types of whole life or universal or permanent. Essentially, there's an accelerated or an increasing death benefit, or there's a stagnant death benefit. So it's really the death benefit selection at the issuance of the policy. And so it seems to be as if yours is it's a straightforward death benefit and you were insured at a specific rate initially. And so this is more of a cash value accumulation scenario where you're accumulating the cash value, but that could outpace your death benefit someday. So that's also a really good opportunity for you when you have that to say, okay, my costs were maybe this at that point, to give me a specific specified death benefit that I knew without a shadow of doubt I was going to have, but the market's done really well. So maybe I can use that cash value, set in a new floor, increase my death benefit, and utilize that cash value to get your hands on it. So that's a really great scenario to have it reviewed for a potential exchange.
Yeah. And so what you're talking about is like, there's a 1031 exchange for real estate. There's a 1035 exchange for life insurance. So if I have a life insurance policy where the costs are a lot higher because I bought it a long time ago. And remember, I said that life expectancy is 100 now, the insurance companies are looking at 105. That's an example where the cost of insurance, literally like the overhead on the policy, goes down. Okay. Yeah. You can exchange one policy, many times one policy for another. And Lucretia asks, we have a 20-year term. When is the best time to convert from term to whole or universal life insurance? What is the best option for a married couple, individual insurance or joint insurance? And how long is a piece of string? That's a tough one. I'll let you ladies answer.
Yeah. So on the first question, when to convert, and really quite frankly, on the second question as well, you would need to understand on conversion, understand the options in your policy. The term policy will state, the timing and what your options are for converting to a perm. So we'd really need to understand that, which we can help you review. And the second, in terms of individual coverage or joint, fully depends on what you need this insurance for. If it's income replacement, it needs to be on each of you individually. If it's to pay taxes in the future, if it's to create some sort of legacy, then it could be a situation where it makes sense to insure both of you on one policy, which is you get more coverage for the money because you're insuring two lives with one premium. But that's all something that we can review with you and help you kind of determine what makes the most sense given your situation.
Then private placement life insurance. This is where wealthy people, and by wealthy, we're saying you typically have $20 million plus net worth. We have many clients who sell businesses. Okay. Some businesses sell for 10 million, some sell for 100 million. And believe me, it's for many of these people, they've been working their entire adult lives building this business, and finally they're able to sell it. Here's the problem. You sell a business for $100 million in California, you might pay over $50 million in taxes. And so people say, I'm not going to give half of my life's work, just give it to the government and not get anything back. Okay. So some people are fine with it. Most people aren't. And so there is a strategy where you can take the value of that business and smash it into a life insurance policy and save a lot of taxes, right? And cut that tax bill way, way down. So that's what we're talking about here with PPLI. And if that's something you're interested in, you can either reach out to our firm or Ascent, either one of us, and we can start that conversation. Lucretia says, thank you. I keep saying that. Nice. Good. So good. All right, let's talk about reviewing existing policies.
So this goes back to the original kind of question that we just covered of reviewing and repurposing. How do we do an exchange or a replacement? And so really that occurs when you have a scenario like we covered with regards to increasing cash value, but not increasing death benefit. That might be an opportunity for a replacement. Your needs have changed. So there's a change in life or financial circumstances. Really that the main things that we see are mortgages are paid off, or you're entering into retirement, or the kids just exited college, and you no longer have those heavy burdens that you would need to possibly cover if someone were to pass away. No longer need a large death benefit. Again, kind of going back to large debts that need to be paid off. Or income replacement if you're in those high income earning years and you have a lot of life left. So those are really opportunities. Products have evolved. Jim has talked a lot about, legacy policies where the cost of insurance has come down significantly. There's also more types of insurance available. So there's a lot more flexibility with what we can do with specific policies that you might not have had the opportunity to do when you originally purchased your policy. So more coverage for the same premium, less premium for the same coverage, added living benefits. So really when we look to review somebody's whole or index universal policy, what we're looking at, or even term for that matter, we can't do anything with cash value, but we can also look at the premiums that you're paying on your term and see if it makes sense to convert or not convert on that particular policy, but get a new policy altogether with the same premium or lower those costs. Really what we look to do is increase your living benefits, reduce your premiums, or increase your death benefit, or all of the above. And sometimes we hit all of those. And so it's really a good opportunity if you're sitting on something that's over 5 years old, is generally the rule of thumb to have it re-reviewed.
Yeah, and I'll just say this, it's actually against the law in California to get a discount on a premium. So basically, the life insurance industry, they've got this nailed down. These are a lot of smart people, very creative people. They're developing new products, but something to understand is the price of what we're talking about, the price of insurance. Whether you go to one agent or another, you're going to pay the same price, okay? Because there's no discounting involved. And how do people make money? They make money based on something called target premium. So there's a fixed dollar amount. And because this is part of the process, because if you're watching this, you're like, well, why are you doing this? If you sell life insurance, yes, there's a commission involved, but something to understand is there's no discounting. That's completely illegal. And essentially the fees the commissions are fixed. And it's really important to understand this, because when you go to maybe reach out to an insurance person, you might be thinking, an insurance professional, you might think, is this person just trying to swap out a policy that's just as good as another one? That is called churning. That is illegal. But something also to understand is a certified financial planner is a fiduciary. They have to put your own interest before their interest in getting a commission. And I will tell you, I know that Shannon and Alyssa and Christina, who's not on the webinar here, they take this very seriously, and they will only do something when it's in the client's best interest. And so we're professionals. We put, and obviously lawyers have a fiduciary duty as well. We put our interests after those are secondary to the interests of the client. So walk us through, help us walk through a 1035 exchange. And if let's say I have a life insurance policy and I say, you know what, I don't really need this death benefit, or I do need the death benefit and I want a lower premium. Right. And what that means is we've had many cases where clients are paying $5,000, $6,000 a year in premium. After they do a 1035, that premium goes away and they still have the same cash value. They actually have a better product, better life insurance product. Or if I'm concerned about, you know what, I've got this life insurance policy, I'm concerned about long-term care. So can I switch that to a long-term care policy? And then also if I have a life insurance policy, but you know what, I really need to tap into this to get an income stream. Maybe if you can just walk us through how these 1035 exchanges work.
Sure. So 1035 exchange is a section of the IRS code that allows a tax-free exchange or replacement. And so any cash value accumulation, things like that, a lot of people hold on to their policies dearly because they're afraid that they're going to get taxed if they do anything with it. There's a section in the IRS code that allows us to exchange those from one policy to the next without having to realize any sort of gain or income. And so what are the things that the IRS accepts? And it goes life to life. So if you have a life insurance policy, we can go from life to life, and that's easy. We're just replacing in kind. We can go life to annuity, because ultimately annuities actually are taxable at death. And so what the IRS says is, if you want to have a tax favored vehicle in life insurance and exchange it for an annuity for a less tax favored vehicle, you can absolutely do that, because it's a benefit to the IRS. So the IRS doesn't care that you do it. And then life to long-term care. And that kind of goes back to Shannon's initial point of, who needs life insurance and how much is enough, and, what things to consider. And really, this is the big one that we see, where people bought life insurance in those early stages of life where they're paying off a mortgage or high debts, have kids in college, they're in their high income earning phases, they have, dependents and so on and so forth. But then they've held this policy for 30, 40 years, and now they're in their 60s, 70s, and they're looking down the barrel at possible healthcare issues and healthcare costs. And so that's a great opportunity to say, I have this life insurance policy I don't need, and it doesn't have the benefits that I need anymore, but I don't know what to do with it. Have it reviewed, and we can certainly replace it for something like long-term care.
All right. We have a few minutes here. We had a couple questions. What if I have 3 life policies that parents set up 50 years ago, another through the employer, et cetera? Do they all pay out, or do my survivors have to fight for the benefit? Well, anonymous, you have a beneficiary designation that you should have filled out and signed and tendered back to the insurance company. When you die, the people who are named as beneficiary go to the insurance company. 2 things have to happen. Number 1, the policy has to be enforced. Number 2, the insurance company has to actually find the beneficiary designation, which, believe it or not, sometimes they can't. It's always a good idea to check in with your insurance company periodically, every 3 years, every 5 years, I don't know, before you die, and ask them, hey, if I died tomorrow, who gets this? Who gets this money? If they can't tell you, you need to do another beneficiary designation. Can all policies be converted? Interesting. I think all policies can be exchanged. At term, there's no value there. But can they all be converted or exchanged?
Not necessarily. So term is not always convertible. And so generally you're going to pay more for term that has the conversion option. As Jim mentioned earlier, there's a rider along with it. You pay for that additional feature to be able to turn that into something later. And so you are paying for that additional feature. And so not every term is convertible. Most insurance policies are replaceable. It's just whether or not in a fiduciary capacity we can justify making that change for the client.
All right. So what are we looking at here?
Sure. So this is a case study where we had a client that was a super high income earner. She was the breadwinner in the family, and she had a ton of assets in her IRA. And ultimately she has a lot of leeway between now her current age and when she's 72 and having to stare down the barrel at ridiculous required minimum distributions, which we're going to kick off tons of income. And so this is essentially a strategy that we utilized. She was not insurable. We insured her husband's life, which actually is a dual benefit. So we used this to essentially strip out her IRA and pay large premiums over a very short period of time. And if you notice, it's 4 years. We did this policy last year for her because of the tax law sunset. So we're taking advantage of those lower tax brackets between now and 2025. And what this does is he had an existing policy that had some cash value, and we added money from her IRA to this in that first year. That's why you see that premium is higher in that first year at $217,681. And then the subsequent years for the next 3 years were $175. And so that really brings her IRA balance significantly down, and that will continue to grow on this tax deferred instead of continuing to accumulate inside of her IRA and causing a huge required minimum distribution issue. The benefit in addition to that was we insured it on her husband's life. And so we're stripping out her IRA, which was the larger of the two, the largest asset that they had, and we're getting a large death benefit on him. If he's going to predecease her, guess what? She gets all of that death benefit back in her name. But if they both live a good life and a good long life together, this is also a strategy where we have loans being shown. So if you actually look in that first column on the left and you go down to year 9, you would go ahead and go down to year 9, and you look at variable life, and you say you can see that there's $64,632 coming out to them. That is essentially Roth money. So this is a kind of like a Roth alternative where we're stripping out that IRA. That's going to be a huge RMD exposure for them. And we're providing tax-free income in the form of a loan against the cash value. And the critical component here is it's a loan. It is forgivable to the extent of, if there's cash value accumulation, more so than the interest on the loan, you keep the arbitrage inside the policy. And so ultimately, you hopefully won't ever have to pay that back, but it is a loan.
Yeah, we had a question here that I answered just in the Q&A. Is somebody had a whole life policy. They're like, I'm thinking about just taking the money and closing it out. That's very dangerous, because if you take out more than you put in premiums, that is subject to potentially income tax. You do want to structure it as a loan. So this is where it requires a level of sophistication. I will tell you, working with my father-in-law, who turns 90 this month, he's got a policy of life insurance, and he bought it, I don't know, not 100 years ago, but it seems like it. And his agent is almost as old as he is. He's impossible to get a hold of. So this is like, as you age, like a lot of this stuff starts breaking down, and you need a straight up answer. And it's very hard to get an answer without going through a professional like Alyssa or Shannon. It's very hard to sometimes to even contact your existing insurance agent, the person who's on the insurance policy. Okay, so let's look at 1B, retirement income plus death benefit. It looks like 64,000. And then,
yeah, so that's showing if you actually you total that up at the age of 92. So after 30 years in the policy, they would have put in 742,000 in total premiums over the course of their lifetime, but they've taken out 1.35 million in tax-free loans against the policy over that same span in the policy. In addition, if you look at the far right side, and I'm going to move all these pictures here so I can see it. On the far right side, in that year, 30 years, you're actually going to see that there's still, after taking 1.35 million out, there's still potentially a death benefit associated at 284,000. Now, with this type of a vehicle, you can accelerate down that death benefit. This is one of those living benefits we talk about. So most policies, you don't get any sort of benefit until after you pass, but your beneficiaries or whomever is your successor trustee or stepping in if there were a health situation is paying essentially out of either your assets or their own pocket while you're alive and not necessarily getting reimbursed until after you pass. This accelerated death benefit option on this particular policy gives you a bucket of 284 potentially to drain from while you're living. And you can use up to 20, for this policy in particular, you can use up to 24% of that number each year. So it'll last a little bit over 4 years if you were to drain that. And so that 24% is what's called, and this is kind of a key point with long-term care, there's types of reimbursement policy. The way that claims are paid are either indemnity or reimbursement. Reimbursement is exactly as it sounds. You submit claims and then the company reimburses you for whatever those claims are up to a specific maximum. This particular policy is an indemnity policy. Once you are qualified for long-term care by your own doctor, meaning you would have to not be able to perform 2 activities of daily living. So of the 6 activities of daily living, cognitive impairment is an automatic. You only need 1. So if you have somebody that's got early onset dementia or Alzheimer's or anything like that, it's their doctor. They can qualify them and say, this person is in need of long-term care. Outside of a cognitive disability, activities of daily living include moving from bed to chair, eating, bathing, toileting, and maintaining continence, as well as cognitive. And so those are really where you're going to get qualified for using this type of a policy. And indemnity pay allows you to, once you're qualified, you can use those funds any way you want. So if you want to stay in your own home, and that's really important to you, by the way, 80% of care is given in people's homes. Most people don't go to facility care or full-time care places. They stay inside their own home. And that's a really nice benefit that this policy in particular has, or that indemnity pay policies have, because they allow you to take those funds and you can update your home. You can make them ADA compliant, put ramps in your home, whatever you need it for. Or you can say, I'm dying in a year and I want to take my family on a really nice trip. You can do that too.
So paying for college expense, and we're kind of, let me just get us through this example. You can use life insurance for paying for college. I don't see that a lot. Do you see that a lot with your clients or not?
I personally have them for my kids. I don't like the IRS restrictions of a 529.
Okay.
529s have a lot of components that just handcuff you as far as how you can use them. If my kids never go to college, I want to be able to use and access those funds for whatever they decide to do. And if they don't decide to do anything, and maybe they're just an entrepreneur and brilliant and start their own business, I can use a life insurance loan to fund that.
Yeah. And I think that's sort of the alternative to the 529. Well, this brings us to the end, and go ahead and subscribe to our YouTube channel. Thank you for joining us today. You can review us on Google. And I think we've made it through questions. It's been great to spend time with you, and we will see you next time.